Hey. 8 p.m. Actually, it's 8:01. Sorry, got a bit of a late start tonight. 8:01 p.m. Eastern Time means it is taxes and retirement time of the week. I am Andy Panko, host of this show and one of the moderators of Taxes and Retirement. Thank you all for joining me. Tonight we have a mailbag edition, the Ask Andy Anything edition. I do have two questions preloaded in advance. Thank you for those that sent them. In the meantime, feel free to post up in the comments to this video any questions you may have. As always, for those of you watching along at home, if you do know the answers to the questions, please try to refrain from responding in line to other people's questions, because I can't quite tell on my chat thing here who's responding to something else versus what's a new post. So that's that. Let me just see if comments are working. Yeah. Oh man, Dave Fultz. Funny you said bonjour, because Dave Fultz was one of the two people that sent me a question. And I swear, I just thought about this 2 minutes ago that I was going to say, Monsieur David Fultz, when I introduced your question. And you beat me to it with the bilingualism. Not that I am bilingual en français, but still. Wow, that's really weird. Interesting. Sizzling California. Hopefully you're not burning. I'm here in cold and damp New Jersey, driving down to Delaware tomorrow to meet some clients for the first time in person. It's going to be a washout of a day tomorrow as well, and chilly. But such is spring in the Northeast, I suppose. Okay, so dad jokes, right, for this evening. I will tell you, my wife helped me pick them tonight. Usually she doesn't, but she found some decent ones. Let's see. So I'll start with this. My friend Tony asked me not to say his name backwards. I said, why not? Get it? Y-N-O-T is Tony backwards. While in labor, my wife yelled, can't, won't, shouldn't, isn't. The doctor told me I shouldn't be worried since contractions are a normal part of childbirth. And finally, hold on, you know who I'm queuing up. My little friend. All right. Today I got gas for $1.57. Unfortunately, it was at Taco Bell. Get it? Play on words with gas. I'm not talking about petrol, if you know what I'm saying. Okay, disclaimer before we do it. Man, where am I? Sorry, I'm all sixes and sevens. Or what's it, sevens and eights? What's it called when you're disheveled? Sixes and sevens? This video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I am just some guy answering your questions and hoping to get them as right and accurate as I can. So let me jump into it. Lots of love for the contraction ones. Mark liked it. Cody Garrett liked it. Mary, my wife is not an English teacher. No. I don't recall her having contractions during childbirth. Not the word kind, at least, but anyway. All right, so first question. This is a good one, and I struggled to come up with an answer. And I'll elaborate on that. So Vanessa Ross asks, slightly long, but stick with me here. Can you talk about you provided great information about how to find financial professionals. Can you talk about post-hiring, specifically how to evaluate the quality, effectiveness, and competence of financial professionals who provide plans without active management? After implementing all the recommendations from a plan, just waiting 30 years to see if there's still any money left doesn't seem smart. If you were a client, what measures would you put in place, and at what intervals, to determine the effectiveness of a plan, the skill and competence of the financial planner who created it, and whether one received a good return on the fee paid? As a financial professional, how do you know whether the plans you created without the active management were sound, effective, insightful, and successful? Man, I'm sure Cody, feel free to respond in, reply in on this, because you do this more than I do. Well, actually, you do it. I don't. This sort of plan only stuff without active management. So, Vanessa, a few thoughts. The the value provided by or from financial planning and or investment management is quite obscure. It's exceptionally hard, if not impossible, to put a true value, a true number on the value provided. And a lot of it is because, at least with financial planning, because it is soft things about the future. And there's no way until, benchmarking 5, 10, 20 years after the fact to look at how things performed relative to what you thought they were going to do. How would things have been different if you didn't put the plan in place? And part of the reason I stopped doing one-time plans is the value isn't in that, in my opinion. For some people, yes. Like, one-time plan, in my view, is good for people who really, their finances are kind of scattered. They really, to ask a general question like, could I retire in 5 years? I'm not looking to pin an exact number or date on it. Just generally speaking, could I retire in 5 years? Or if not, is it 20 years? Is it today? A one-time plan is good for like a broad thing like that. And it can also help with some actionable, tangible things like, okay, your homeowner's insurance isn't enough. Like, let's up that a little bit. Or your investment allocations are way off. So let's revamp them now. It's too conservative, too aggressive. Let's do that now. There are definitely specific takeaways from a financial plan. But without like documenting it and comparing it every X amount of years in the future to see what would my life have looked like if I didn't do these items, it's frankly impossible to say what was the actual realized value that you got from this. And this ties into my dislike of the percent of assets model, because that asset size is almost literally zero correlation to value delivered or value received by the client, not just for investment management, but especially when you're doing planning along with it, as most advisors are now doing. Asset size is just stupid. It's so arbitrary to try to pin the value of what you're doing on. Man, where am I going with this? So frankly, Vanessa, like there really isn't a way to know. You get a one-time plan from someone. How do you know if it's good? Again, other than without you keeping meticulous records of what would I have done without the plan and what did I actually do because of the plan, and just sort of like follow along how those two things play out or would have played out over time. That's the only way you're really going to know. And I guarantee almost no one's doing that. So anyway, so I stopped doing one-time plans because while people got some value from it at the time, the plan will inevitably be wrong, because life's going to happen in weird ways that you don't anticipate. Inflation's going to happen in unanticipated ways. Financial markets are going to do what they're going to do. Your own general, what you do, how you do it, your expenses, your discretionary expenses, that stuff will change throughout life. So a plan's going to be old. The plan will be outdated in a matter of time. It's not if, it's when. So I stopped doing it because I feel the value is really the ongoing relationship in helping people tweak and turn and update things along the way, because plans and life and markets and inflation will no doubt change over time. It doesn't mean we can't try to guess what we think they're going to be, from this point looking forward, but they will change and plans will be wrong. So what am I trying to say? I frankly, I don't have a good outcome. I mean, some things, like I said, the immediate takeaway is like, oh, wow, he pointed out that my homeowner's insurance is 2,000, whatever, 200 grand short. So if my house gets blown away by, a hurricane tomorrow, I'm going to have to kick in 200 grand out of my pocket to cover the cost. Like that's real value, right? That's, you can sort of touch and feel a little more. But longer term stuff, like doing Roth conversions, for example. I just wrote an article for Rethinking 65. It should be out any day now, which I'll share it. It's my thoughts about why I don't attempt to quantify Roth conversion value and analysis for people, because it's impossible, because there's way too many things that will change. It's more a discussion of pros and cons and be aware of how and when this could help, how and when this could hurt you. I think that's sort of the takeaway with financial plans. Again, other than those specific action to do items, like, yeah, you don't have a will, get a will. Like, that's important, stuff like that. Longer term stuff, I don't know. It's really sort of be aware of the pros, be aware of the cons, know what you're doing and why, and what you hope to come from it, what the anticipated benefit could be or may be. but it doesn't mean it's going to be guaranteed to happen. You know, like if you plan to live till you're 90 and you end up living till 110, you can't really blame the advisor for falling short, because it's not reasonable to assume people will live well into their hundreds. I mean, 95 is kind of what I use, living well into the hundreds. Not to say it can't happen, but you know, that's the exception, not the norm. But if we didn't plan for that and you live 15 years past our planned life expectancy, it doesn't mean I or any other planner failed. It's just the plan changed, right? Like things were different than what we thought they would be. So I'm kind of rambling now, and it's a terrible answer. You know, the more I thought about it, the more like, man, I do not have a good answer for this. So hopefully, Cody, I see Cody saying some stuff here. So good, thank you, Cody. David Myers as well. David Myers, really good. You know, I trust, appreciate, and like him. So whatever he's saying, listen to that as well, Vanessa, or read that as well. So I'll stop that there, because I don't, you know, you made me reflect on myself. Like, how do I gauge my value and my success with clients? I manage investments, but I don't manage to returns. I don't try to benchmark myself against the S&P, because I'm invest clients in passive indexed based products. Their returns will be whatever the indices are, but customized for their particular allocation that we chose. So yeah, if someone's 50% stocks, 50% bonds, they are never going to keep up with the S&P. That doesn't mean my returns are bad or my portfolio decisions were wrong. It's right for them. So like, you can't really quantify the investment value delivered or provided in that sense. And like I said, the broader, longer term financial planning things like Roth conversions or when to take Social Security or not, we won't know till after the fact, right? If I recommend someone delay Social Security till 70, let's assume it's a single person, they're super healthy. So, you know, we assume they'll live well until their 90s, or at least, you know, well until their 80s. And out of the blue at 65, they get some freak terminal illness and are gone in 6 months. Well, then in hindsight, delaying Social Security is a bad idea, right? We should have taken it. Well, we would take it as soon as we get the diagnosis, or they get the diagnosis. But stuff like that, it doesn't mean the plan was wrong or bad. The plan was still the best decision that we could have made at the time, but in hindsight, it ended up being the wrong decision. So it's really a nebulous, difficult, obscure thing to try to really say what the value is of all this. I know the value's there. I can't prove what it is until after the fact, and hopefully the decisions were right and worked out well. You know, peace of mind, if nothing else, to know someone who knows the angles to look for and is aware of the pitfalls to watch out for. There's value in that. But again, trying to quantify it, that's the hard part. And that's why I'm so against like asset-based models and things, because you can't quantify the value in this stuff, regardless what some industry studies try to say, because those are hypothetical at best. All right, I'll stop that there. Yeah, David Myers. It's hard to quantify confidence and stress reduction. That's a lot of what financial planning is. And I'm not saying that as like a half-ass cop-out statement, but that really is a lot of it. And for some people, they're never going to see and appreciate or get value from it. I don't want to say they don't appreciate it, but some people don't care about stress and confidence. Some people are hung up on, you know, you're just some guy to get investment returns better than the market, in which case I'm not your guy. I go somewhere else. Some people can only get hung up on trying to quantify things they can measure. A lot of this financial planning stuff cannot be measured. And so for some people, they're never going to hire a planner because they can't get themselves to see the value in it. And that's fine for them. Other folks, they realize it is this sort of more abstract thing. I'm not just saying it's to blow smoke up people's rears. It is this more abstract thing that I struggle to articulate the value. I feel like, you know, when you see it with the clients I work with, I like to think, since we've been working together, there was some aha moment or some big revelation, like, wow, okay, Andy just did something really cool for me and valuable. I like to think people see it over time, but I'm sure there's going to be people I work with where fast forward a handful of years, they're like, I'm not seeing it. Why am I paying you $9,000 a year? In which case they could be right. You know, for whatever the reason is, they may not be seeing or interpreting the value the same as other people would. Doesn't mean value is not there. It's just not there for them. So lots of vague answers to this, but it was the best I can come up with. And I did put a lot of time into thinking about how to try to answer this coherently and meaningfully. So hopefully it helped somewhat, Vanessa. All right. Next, this was the one from Monsieur Davy Fultz. What are the 3 most common cognitive biases you see in the clients you advise? How do you remediate it? Cheers very much, exclamation point, and like a fox emoji or something. So thank you for that, Mr. Fultz. I'm thinking about this from like the investment perspective. There's like a dozen different cognitive biases that come into play with investments. I think I did a video on it once early on. So I think there's a few. Bandwagon. So I looked these up. I had to refresh myself on the names of these things. Bandwagoning or groupthink. Kind of feeling like you need to do what other people are, and a lot of these things tie together. Feeling like you need to do what other people are doing or saying by being in Facebook groups, by looking at YouTube videos, by watching CNBC. You keep hearing Roth conversions, for example, and people think they need to do Roth conversions. And some people could benefit from it. Other people definitely do not do it. But nonetheless, people, they get to see it in their head, like everyone else is doing it. There's got to be something to it. So I probably should as well. So, I mean, I gave the Roth conversion example, but the same holds for investments, right? You hear everyone talking about, Tesla 2 years ago or whatever, gold a month ago or, whatever, TIPS, Treasury invested inflation protected securities now. That's bandwagoning. Not to say it can't ultimately work, if you're lucky, you're on the right side of a bandwagon that's moving in the right direction, but bandwagoning is a big one. Recency bias. I don't know a technical name for this, but recency bias. And this is probably the most common. So when there's a bad day in the markets like there is today, people's, innate reaction is, oh man, we should get out, right? That's the wrong thing to do. Selling low is not what you want to do. You want to buy low, sell high. Easier said than done. But selling when you're uncomfortable, when there's fear, assuming you're properly allocated, which is part of my job, is making sure people are, that they don't have too much or too little risk. Nastiness like now will happen. So, I have gotten calls before in bad markets where things are down 2 or 3% a day. Like, should we get out now? I'm like, nope. And I just reiterate the plan and why we're staying the course and the other things we're doing to help manage, sequence of returns and delaying Social Security and maximizing pensions and whatever. And then same client, a few days later, the market started tearing back upwards and was up 2 or 3%. And the question to me that day was like, should we buy more now? And I'm like, no. See, so that's recency bias, right? Whatever's happening most recently is kind of, you think is going to continue, and you kind of jump onto that. And finally, there's sort of two words for this: anchoring or information bias. Information bias is simply you're stuck on hearing info you heard, even if it's wrong. If CNBC says something or you read it in a blog or whatever, it's in your head. Now you're anchored to it. Like you're going to have a hard time shaking that out of your head, even if you know it's wrong or find out it's wrong. It's still kind of ingrained in you and subconsciously may impact your view or decision to do or not do something. So that's what I think are the larger, most common cognitive biases in what I do and people I work with. Not just people I work with, but people in general. Those are pretty common defaults. Thank you for the question. All right, that's it for the initial questions. Why do I have Dave Meyer's comments still up here? Okay. So let me go up to the top and just look at questions here. Okay. Mark Trotman is exactly right. A plan is out of date once it is printed. Planning is an ongoing activity. 100% right. And I did used to do one-time plans where I'd print out a few dozen page report with lots of graphs and projections and whatever. Rip it up and throw it out, right? Again, it's good to tell you, are you generally on track for something? Yes or no, but you cannot use a plan today and expect it to reasonably come close to accurately mapping out the next 30 years of your life. It will be wrong. It will be outdated in a matter of time. Okay. Dave Myers regarding value planning. What questions did the plan raise and answer that you did not find or fix on your own? Again, intangible stuff that's hard to measure, quantify, but that's the value in what we do here. All right, here's a question. What do you think are the advantages and disadvantages of extending the age of required minimum distributions to 75? Yeah, I have mixed feelings. The people who are always have the view that the government's out to get them, and there's some underhanded plot to all this, think extending RMDs is really just a larger money grab for the government, because by further delaying people having to take money out of their tax deferred accounts, there'll be that much more tax when tax is paid on it, whether it's by the original owner or when it's passed on to kids. And I even read in some other group that someone thought, yeah, the government has this all calculated out. When people pass money on to their kids, the kids are typically in their peak earning years, therefore highest tax years. So let's dump this inherited money on them, let them pay the tax, which sure, there's some element of I can see where they're coming from. I'm not giving the government that much credit to think this is all like some well thought out plot to get that much more tax from people to further let them delay. I'm sure that will manifest itself to some extent, but I don't know. So that's one of the downsides, is if you do continue to delay your RMDs, you may just be further compounding an already potentially large future tax issue for yourself. The upside is those that don't need it don't have to take it for a few more years. And there's lots of ways this can go. But if someone is leaving most of their tax deferred money to their kids, let's say, and let's assume their kids are starving artists, well, it's actually good for them. Let the kids pay the tax on it instead of the parents, because the parents may be at a higher tax bracket. So if you know you're going to be generationally transferring money, or not even generationally, but leaving it to someone else, anyone else, like maybe you're leaving it to a charity, for example, then good for you. You can maximize how much is in your IRA. So there's that much more to be left to charity. Charity doesn't pay tax on it anyway. So everybody wins except the government, in which case, good. We all do better except Uncle Sam. I don't think this is a big deal from my perspective. People who need the money to live on, they're already taking money anyway, probably more than their RMDs. So this isn't really benefiting them. Those who don't need the money, you can sort of view this as a benefit, because I think, Mark, I guess this is what you're replying to. It gives you 3 more years of potentially doing some proactive tax planning, so you can have better control over how your income is taxed, as opposed to having your income and taxation forced upon you from RMDs. I'm a fan of it getting delayed. Again, assuming you know how to use it wisely. Like, just because you don't have to take it doesn't mean you shouldn't. If you're in a low tax bracket, you definitely should take some. Fill it up. Have control over how and when your money's taxed, as opposed to letting your lower tax brackets go unused in any given year. So that's my thoughts on that. We'll see how it plays out. RMDs I think are goofy. I sort of wish they'd just go away completely. I don't know that will ever happen. I understand why they're there. The government has let you defer paying tax on this money for decades. They want to get their piece of the pie eventually. So I'm not opposed to the idea of RMDs. It just makes planning a little interesting. Here's another good one from David Myers. A good financial advisor spends a good bit of time telling people things they already know, but need to hear from someone else. Yeah. Facebook user. I did a backdoor Roth last year, but while doing my taxes on TurboTax, it keeps showing as a traditional IRA and that I do not qualify for it. Called Fidelity, and they say they sent the right 1099-R. Any suggestions on how I can fix it? Thanks. Has code 7 on box 7. What should the code be? I forget on a conversion. No, it's not right. Well, depends what you're talking about. Do you mean the 1099? Yeah. So, okay, never mind. You're referring to the 1099-R from the IRA. No, I don't think it should have code 7. I think it's code. It depends on your age, actually. So if you're under 59 and a half, I think it'll have code 2. It'll say like early withdrawal exception applies, or early distribution exception applies when you do a conversion. If you're over 59 and a half, I think it may say 7, or at least it wouldn't matter if it says 7, because you wouldn't have to pay the penalty anyway, the 10% penalty, I believe. Also, I think right under where it says gross distribution, it should say taxable amount not determined. There'll be a little checkbox. Typically, that should be checked, meaning the taxable amount of that distribution is not determined. Man, I have to look and go back and look at 1099-Rs. But it's ultimately on you and how you reflect it in your tax return. Now, if the issue is TurboTax is getting hung up because the 1099-R is worded incorrectly, that's a different story, or coded incorrectly. But you might be able to override it somewhere. I'm not familiar with TurboTax. I haven't used it myself in like 20 years. But in my tax prep software, there's a screen where I can enter 1099-Rs. And there's a separate flag on there. It says disregard this distribution, because I'm separately manually entering it as a Roth conversion, which is into a different screen. So I then entered that distribution as a conversion on the conversion screen, as opposed to just letting it stay in the 1099-R screen. So sorry, I'm not sure without digging into TurboTax and what it's doing. I don't know what the fix is or needs to be. Thank you for the question. Ooh, Shauna's response to the RMD thing. I'm skeptical that there are some other tax reasons behind the move to 75. Do they have more taxation plans up their sleeves than else? Yeah. So, and this could definitely be part of it. I mean, I think it's safe to assume tax rates are more likely to go up than go down, or taxability in general is more likely to get higher instead of lower going forward. So maybe so maybe this is part of the reason that they figure let's continue deferring some of this income. The government, continue deferring taxation of some of this until we're in a higher tax regime. It's definitely possible. David Myers thinks it's political cover for other things. Yeah, the only ones who benefit from it are those who can afford to not pull money from their IRAs anyway, which is a relatively small portion of the population. A lot of people take more than their RMDs because they need the money. So, all right, what other questions do you all have? Man, not a lot so far. More about this RMD stuff. Okay, so this was back on that. Yeah, so if you're over 59 and a half, I believe it's okay that box 7 says 7, which is normal distribution. The onus is now on you by way of your tax return software to make sure that's reflected as a conversion. Now, it's still going to be taxed. Well, the taxability of it will depend on how much other money you have in your IRA and how much of it's pre-tax. So you'll have to do Form 8606 as part of your tax return. That's what will calculate out how much of this conversion, if any, is taxable. So maybe that, search around in TurboTax for Form 8606. That may help get you to the answer that you're needing to get to. But yeah, box 7 in that 1099 is probably okay since you're over 59 and a half. I think that sounds familiar for conversions I've seen for people over 59 and a half. That it's code 7 in box 7. Or maybe I'm making that up now and confusing myself, but I think that's right actually. So it might be more of a TurboTax issue, not a Fidelity issue. Say your employer plan allows Roth 401k and after-tax contributions. Is it better to utilize the after-tax contribution within the employer plan or invest in a taxable brokerage account? So just to clarify for folks, there is a difference between Roth and after-tax. Many people get the two confused because a Roth contribution is after-tax, the contribution. But in 401k speak, it's different things. Roth contributions mean the money you put in do not get you a tax deduction. That's correct. So therefore, it's after tax. But all the money and growth within that Roth account will eventually be tax-free. With an after-tax contribution, it's money you put into the plan. You do not get a deduction for it, hence after tax, but that money goes into your traditional 401k pot, which means all the earnings on that contribution will eventually be taxable. So that's the difference. With that said, I generally think use the Roth first, and let's assume you max out your Roth contributions of whatever it is. I forget the number, 20 grand a year or plus to catch up if you're 50 or older. If you want to contribute more above and beyond that, I say just do a brokerage account as opposed. Now, this isn't specific advice. Everyone's situation is going to be different. And if for whatever reason, you think you're going to be an exceptionally low tax bracket in the future, then maybe after tax contributions are the way to go. Defer those gains, worry about the tax down the road as opposed to sooner. But generally, again, not specific advice. If you're not getting a deduction for it anyway, and you're not getting the benefit of tax-free growth like you are in a Roth, I would lean towards saying just put it in a regular brokerage account. Now, do it tax efficiently. Don't put it in mutual funds that have big capital gain distributions. Try to use ETFs or even single stocks that don't throw off any dividends or anything if you're a single stock kind of person. And all those gains will eventually be long-term capital gains, which are lower tax rates than ordinary income, which is how it'd be taxed if you put the money instead in your after-tax 401k account. All those gains are eventually going to be taxed as ordinary income. So that's my thought. And you get a little more flexibility. Like you can access your brokerage account money whenever, right? There's no penalty on it, depending how old you are and how much you put into your after-tax 401k. There's going to be limitations around you taking it out and stuff like that. So a little more flexibility. I generally lean towards putting that money in a regular brokerage account as opposed to after-tax 401k. But again, different people's situations may warrant a different answer. This may be a nonsense question, my favorite kind of question. This may be a nonsense question, but I'm kind of confused. If the inheritance tax is maxed at 12 million, and if someone actually doesn't have that much to start with, what is the use of having a revocable trust or will if we simply can have beneficiaries in all our retirement accounts? Perhaps just okay, got cut off. But I think I know where you're going with this. So a few things, and I'm not a lawyer, nor do I play one on Facebook, but few reasons. I'm not convinced people need trust. California, different story. Dave Myers knows more about this than me, but part of the benefit of a trust in California is California apparently has a relatively high probate fee, where that fee is based off the size of your assets that go through probate. So all else equal, the more things you can keep out of the probate process and have passed to people by way of a trust, the fees and costs associated with your estate administration will be lower in California. Different states have different things. So that's one benefit of having a trust if you're a California resident, is to eventually minimize the fees of going through probate. I don't remember what the fees are, but I believe it was tiered or something, Dave said. The other benefit of a trust is simply estate administration, ease of administration. When things are in a trust, you don't have to wait for the probate court to start the probate administration and have a judge approve your will, and eventually, whether it's weeks or months, pass the stuff through to your people as per the will. When it's a trust, in theory, this stuff can all happen like lickety split. You die tomorrow, trustee steps in and starts doling your stuff out just like that. I mean, it may not be that simple. I'm simplifying it too much, but a trust expedites the estate administration process. A trust is also private. So if you care about whether or not wills, when you go through probate process, that's public knowledge. People can find out your house, your investable assets, whatever. Anything that goes through probate is public knowledge. Things that go through trust are not public knowledge. So if you want to keep the knowings, from the world, from knowing what you have and how much it was worth, then yeah, maybe go the trust route as opposed to the probate route. But a trust isn't there to save you taxes. And to your point, I'll take this off. I think people had it up there long enough. At the federal level, yes, you can die with up to $12 million worth of estate. And that's everything. That's your house. That's your taxable brokerage accounts. That's your IRA accounts, your 401ks. Life insurance you have on yourself that gets paid out. It's part of your estate, I should say. You have $1 million term life insurance policy and you die, even though that policy gets paid out to your spouse as beneficiary or whatever, your kids, that $1 million still lands in your taxable estate. So don't forget that. If you have a lot of life insurance, that could potentially put you over. $12 million is not likely for many people, but anyway, you're right. At the federal level, given the estate tax limit is so high, most people aren't going to hit it. So trusts aren't there to save you on estate taxes. It's there for the other reasons I mentioned, to save on probate costs, to ease administration, to keep your probate process private knowledge, so people don't know what you have and how much it's worth. At the state level, a little different. Now, in addition to the federal estate tax limit of $12 million, or state size limit of $12 million, which is dropping by half. In 2026, it's due to get cut in half to roughly $6 million, which is still plenty large enough for most people. States can also have their own estate taxes separate and distinct from the federal one. And I think it's less than 10 states have death taxes, either inheritance or estate tax. But that could be another reason. If you're in a state that has like a really low estate tax limit you're trying to avoid, then taxation maybe is an issue, in which case trusts still aren't really going to help you with the tax aspect of it, because trusts don't reduce the tax. They just kind of shield it from public knowledge and help, again, ease the administration of the estate. So hopefully that answered the question. I don't know if that's exactly what you were asking, but that's how and why trusts come into play in the estate process. And there's more to it than that. Trusts can be lots of things. Like, trusts are there for protection and control. It's not to save you taxes necessarily, or if at all. It's protection and control. So if you want to leave your money to a kid and you have a kid who has substance abuse issues or is about to go through a nasty divorce, so you don't want his or her spouse getting their hands on the money, you can leave that kid's inheritance in a trust. And you can control from the grave how and when your kid's able to get that money and who else is able to get their greasy hands on it. So that's the real benefit of the trust, is protection and control. It's not to save you on taxes. And it does have the other benefits, like I said, keeping your stuff out of public eye when you do die, and easing the estate administration process. Under 55 on Social Security disability, I know person won't be taxed to withdraw IRA money, but do you know if he'd... I got cut off. Sorry. I don't know. Okay, what's this? If parents put their house in the children's name when they die or move into a nursing home, is the sale of the house after 10 years of when it was transferred to the kids a taxable event for the kids, or is it considered inheritance and the tax based on the... I think this, you may have just emailed me, whoever this is. So at the time the house was put into the kids' names, if by put into the kids' names, you mean like the legal title was transferred over from the parents to the kids, that's a gift. The house was given to the kids at the time. The kids were the rightful owners from that point forward. The basis or the cost in the kids' hands would be whatever the parents' original basis or cost was. You can't get rid of the basis. It just transfers over to the recipient of the gift. Now, so we're assuming this happened over 10 years ago, so it's beyond the clawback for like Medicaid coming and trying to scrape the house back into the parents' estate. So you don't have to worry about that. But if the kids sell it, yes, it will be as if the kids always owned it, and their basis is whatever the parents originally paid for it. So the gain the kids will have will be the current value they sell it for minus the original cost. There's some other adjustments to it, like realtor fees can be deducted, other closing expenses, any improvements that were made to the house along the way can all add to the basis. But otherwise, yes, it is the kid's house. It's the kid's gains to deal with if and when they sell it. I told the accountant that I may convert traditional IRA to Roth this year and also sell mutual funds that will have large capital gains. I'm sending IRS estimated taxes, but they're not enough. We'll have to pay a penalty. Oh, depends. There's lots of things that go into answering this. The best I can say is check out the previous videos and lives I've done on this. Check out my YouTube channel. I hit this topic 3 or 4 times. Not a simple answer. It all depends how much, or it all depends how short you are in total tax, and when in the year you made the estimated payments will ultimately dictate whether or not you're subject to an underpayment penalty or not. Sorry, I got cut off. Here we go. Perhaps a revocable trust is just good for property that's going to be left to the children. Yeah, it depends. Like I said, there's lots of reasons someone would or wouldn't need a trust. There's no simple answer to, do I need a trust, or is a trust good for me, or whatever. TurboTax asked the question, what did you do with this money? Yes, I'm not familiar with TurboTax, but it should. I know lots of people do conversions and stuff and have to deal with this 8606 basis tracking thing. So it should hopefully prompt you through its questions to get you to the accurate forms that you ultimately need. But I really not a TurboTax expert. Sorry. Andy. Shauna asks, would you explain Social Security cliffs? That in combination with IRMAA, Medicare surcharge cliffs. That delicate tightrope balance. Maybe this topic could be at a later date time with some graphs to show us. Thanks for always being so awesome. Triple exclamation point. Well, thank you, Shauna. Yeah, let me for now, I refer you all. I did do a video, a scripted video a couple years ago, and in a Facebook Live less than 2 years ago on Social Security taxation that describes the cliffs. There's a special measure of income called provisional income that determines how much of your Social Security is taxable. There's not really cliffs with that because the amount of Social Security that is taxable is this sort of scaling percentage. It's not just like once your income's over X, boom, you jump right to X amount of your Social Security getting taxed. It's not quite like that. So Social Security taxation isn't really a cliff, even though there are definitely defined, income thresholds at which taxation gets invoked. IRMAA cliffs, different story. IRMAA is, again, Medicare surcharges. If your income is over certain levels, whether it's $1 over or $10,000 over, boom, you get the same amount of monthly surcharge applied for that year at least. And then the surcharge is reset every year based on what your income was 2 years prior. And I did this, multiple different videos, so check those out. But yeah, maybe we can revisit this going forward. Might do another live about IRMAA, since it's a common topic with anyone who's going to be, of Medicare age at some point. Good question. Yeah. Okay. So David Myers with the trust thing. Facebook user question: is there a look back on gifts, including the $16,000 in kind, for calculating the estate value? If I pass out a huge chunk just before passing, does it get added back? Well, that's a good one. I feel like I should know this, and I don't. Let me think about this. You know what? No, I don't. No, it doesn't matter. Here's why I say that. So that the $12 million estate size limit, over which if you die with more than $12 million, there will be an estate tax on the excess over $12 million. That 12 million limit isn't just your estate size. It's called the unified credit. Or at least it used to be. It changed names. I don't know if it changed names to or from unified credit. But that $12 million lifetime limit, you can use up in life or in death. What I mean by that is in life, you can gift away up to $12 million while you're alive before you have to start paying on any excess gifts you make after that. Or if you don't gift away anything, let's assume, then you can die with up to $12 million of stuff and not have to pay federal estate tax on it. Now, what if you gift away $2 million of stuff during your life? The way that would work is you use up $2 million of your 12 million limit, such that when you die, you can then die with only $10 million of estate value. If you have more than that, then the excess over that will be subject to estate tax. So that's how that credit works. So to answer your question, no. And the nice thing about giving away the annual exemption, which is up to $16,000 per year per person, that doesn't count towards your $12 million lifetime. You can give as many people as you want $16,000 this year. You can walk down the street with a fat stack of cash. Fake. It's fake. Just kidding. Hey, I can hand out 16 grand in cash to every single person on the street right now. The IRS never needs to know about it. They don't want to know about it. You have to tell them. It's not taxed to the recipient. It's not taxed to me. It doesn't show up anywhere. It's just given away. So you can do that to as many people as you want. That will not get clawed back at all into your estate thing. If you do give more than 16 grand in any 1 year, well, specifically for 2022, that's the limit. If you give more than 16 grand to anyone in 2022, you will need to file a Form 709, which is called a gift tax return. Now, unless you've gifted away more than $12 million, excluding all these annual 16,000 things, unless you've already gifted away more than $12 million, you're not going to owe tax on giving that gift. But you have to report it to the IRS, because that Form 709 is what keeps track of how much of your $12 million you've gifted away during life, so that when you die, whatever's left is your remaining estate tax size exemption. Make sense? So no, gifts aren't pulled back, because gifts already trim down, if you gift enough, already trim down that estate tax, that estate size exemption. Great question. Inherited single premium immediate annuity from a non-spouse from pre-2020 rules. Surrender schedule has been met. Could this get moved to a Vanguard or Fidelity as a simple inherited IRA? I don't think so. My initial reaction is no, because a single premium immediate annuity, once it starts, it's just a lifetime stream of income, done. But annuities could be concocted in lots of ways. So I think you'd have to check the specific annuity and see what the death provisions and beneficiary provisions are. If it's only you can continue receiving payments for the remainder of your life, then that's what it is. If it does allow you some sort of portability or rollover process to dump some actuarial present value of those payments into a lump sum inherited IRA, then maybe yes. But I don't think you can, but check with the actual annuity to see what it allows, if anything. Is the trust good if you have minor children? Depends. Again, depends what you want with it. So if your concern is you pass and your kids are still minors, do you need a trust? I don't know, and I frankly don't work with people that have minor kids. One couple, maybe two couples. It's not really my thing, but so there's going to need to be a custodian. If someone's a minor and they inherit an IRA, for example, there needs to be like a custodian involved in that. A minor can't have an inherited account of their own, for example. So I don't know if that custodial arrangement is enough where you don't need a trust because that custodian is there. And that custodian, this is why you need a will, because your will appoint who the guardian or custodian is going to be of your kids. Maybe just simply having that adult in the room is enough comfort for you that he or she will make the decisions that's best and right for your kids. So I don't think minor kids just get money dumped on them. There needs to be some adult in the middle that makes decisions for the kid, just like you do, as the parent. Now, if it's non-minor children, your kid's 22 and you're concerned about leaving, he or she a $2 million windfall, then yes. If you don't think they'll use it wisely, then yes. Then you almost certainly need a trust because the kid's an adult. He or she is free to do with the money as they please, unless you put it in a trust to restrict how the kid uses it. So, but minor children, I don't know. I don't think you need it because, again, I believe there has to be a custodian or a guardian involved in the kid, and he or she should be acting on behalf of the child, such that the child doesn't need a trust to limit the money for them. Yeah, great point, Mark. So regarding the probate and dying process and passing on your stuff, certain things pass outside of probate, outside of wills. Life insurance, right? Make sure you have the proper named beneficiaries on your life insurance. When you die, that life insurance gets paid out to whoever's named on the policy. It doesn't matter what your will says, doesn't matter what the court says, it goes right to whoever's named on your policy. Same thing with qualified retirement accounts, IRAs, Roth IRAs, 401ks, 403bs, Federal Thrift Savings Plan, 457 plan. Those pass to whomever is designated as the beneficiary on that plan. They do not go through your will. They do not go through the courts. So important for people who, set their beneficiaries 30 years ago and never changed it. If you got divorced or remarried since, if you named the beneficiaries no longer on this planet, make sure that's updated to, always occasionally revisit your beneficiaries to make sure they're accurate and who you want and need them to be, because your will's not going to trump them. Your beneficiary designations dictate where your qualified retirement accounts go, where your annuities go, where your life insurance goes. Great point, Mark. Where do we go? Oh, yeah. Got to go. Thanks, Dave Myers. Always a helpful contributor here. Facebook user, I understand the importance of staying within your tax bracket, but since the look back begins at 63 for Medicare IRMAA and net investment income tax, do you think it would be beneficial to do a big Roth conversion when you're 62 and then smaller ones after that? Yeah, this is what makes tax and distribution planning for people entering retirement difficult, especially when you're around this Medicare age. Man, you're never going to avoid NIT. So the net investment income tax, NIIT, is an additional 3.8% flat tax that gets applied on passive investment income like dividends, capital gains, interest, passive rental income. If your gross income's over a certain level, I think it's $250K for married, $200 for single, if I remember correctly. That doesn't go away. That's not specific to age or Medicare. That is what it is. It's always going to be there unless tax legislation changes. But Medicare surcharges, correct, they look back 2 years. So Medicare starts when you're 65 for most people, assuming you're not at a job that has qualifying replacement coverage. And so when you're 65, your income in the year you're 63 is going to start to matter because these Medicare surcharges named IRMAA look at your income 2 years prior. So to your point, yes, all else equal, if you're planning on doing Roth conversions and they're going to put you into IRMAA territory, it will be better to do them before the year 63 and therefore not going to be subject to IRMAA, as opposed to doing them when you're 63. Now, I also say don't let the tax tail wag the dog, and IRMAA is one possible example. The first tier of IRMAA isn't that punitive. It's like $70 a month or something per person, which isn't great, but it's not terrible. It's when you get into the second, third, fourth tiers of IRMAA where you're paying a few $100 extra a month on top of your base premiums, then it starts to sting. But the difficulty in all this planning is how big of a potential tax deferred lump of money do you have? If you got $5 million in an IRA, maybe you should aggressively trim that down, even if it means paying a few $100 a month in IRMAA, because the long-term tax savings you'll hopefully potentially get from trimming down your $5 million IRA can hopefully outweigh the few $1,000s of IRMAA you're going to have to pay now. Now, there's no way to prove that. This is part of the difficulty in tax planning. And like I said, if you were here earlier, why I wrote the article about the futility of trying to quantify the value of Roth conversions is because we're trying to make blind guesses about the future of tax legislation and financial market returns and your own longevity, which any one of those things is impossible to predict, right? So, man, I'm off on a tangent. So yes, you're thinking about this the right way. Be aware of the things that come into play. And that's the value in advice and planning. Having someone who knows the pitfalls, who knows the pros and cons, who knows things like IRMAA and the net investment income tax, not to say they should stop you, but at least be aware of them and what their impact may be so you can make a better informed decision about should you do a Roth conversion or not, or if you do, how much should you do, just to know the potential impacts that that action is going to have. Good question. Yep. So the 12 million estate exemption will be reduced. It's already written into, it's part of the Tax Cuts and Jobs Act. The estate size exemption was doubled as part of that, and it's due to revert back to what it was prior, which means getting halved, which as of now is slated to happen in 2026. So it'll be with inflation increases. So by the time 2026 comes around, it'll be at least $6 million. While with inflation now, it'll be like $7 million probably, unfortunately. But yeah, it will get cut in half as of now. What is the best way to fix a tax-inefficient taxable account, such as high-income funds, real estate investment trust funds? Should I sell these funds and pay taxes on the capital gains and or invest new monies in more tax-efficient funds, single stocks? Thank you. Yeah, there's not a great way. So one thing I did with one client who has sizable mutual fund holdings in a brokerage account, it got really hit hard with capital gain distributions last year. What we did was first turn off automatic reinvestment of distributions. So you're not further buying more of the same fund that's going to continue to give you large distributions going forward. We did tactically sell off a large chunk of some of the clients' mutual funds this year. Or was it last year or this year? It was this year, I think. Yeah, this year. Trying to do it tax flat. So some were at a gain, some were at a loss. We were able to pair off just enough to, sell off all the losers. We knew what the realized loss was, and then sell off enough of the winners to just flatten each other out. So the net tax impact actually was like a net $1,000 loss, which is right where we're shooting for. So it worked out brilliantly, if I have to say so myself. But that was one way. Now, if all your stuff is at gains, you're not going to have that discretion to kind of tick and tie to sell stuff at a flat wash of a net loss or gain. So now the question, is it worth selling stuff off at gains, realizing the taxability of the gain now? I don't know. It depends what you're trying to solve. It depends what your other taxes and incomes like for the year. Do you want to stuff yourself with capital gains now for the benefit of minimizing additional gains in interest and income going forward? That's a tough one. Without knowing the specifics of your life and financial circumstances, I can't say. Other options are, you can donate it. Not only do that if you're charitably inclined, but you can donate the stuff away. Maybe get yourself a little bit of tax break on that donation. But again, only do that. And this goes to everyone. Never do charitable donations purely as a tax play. Do it because you're charitably inclined, first and foremost. The tax savings are never going to make you better off because you're giving away $1 worth of stuff to save yourself 20, 30, 40 cents worth of tax. You're still out 60 cents, 70 cents, right? So don't, I'm not disparaging people who give to charity. It's great, but do it because you're charitably inclined. The tax benefit is a secondary, ancillary benefit. Never give money away purely to try to save yourself taxes because you're still worse off financially. If you can couple that with meeting your charitable, giving needs, then perfect. Everyone wins. But anyway, why I say, so I'm saying, like, don't donate away stuff just to try to save taxes because you're still going to be less, you'll have less financially as a result. The only other thing, you can gift it, not donate it, but you can give it to people like kids or family members if you want. Let them deal with the tax impacts, for example. And this could be part of like legacy planning. If you have kids and they're in a lower tax bracket, and you're going to end up giving a lot of money to them, maybe start doing it now during your lifetime. You can gift off to them some of these mutual funds. Let them deal with the tax burdens, and maybe they're in a lower tax bracket than you, so it's better they pay the tax than you. This one sort of, no, yeah. There's something called a exchange fund. Not great in most cases, but basically you can transfer in. Nah, I forget. I'm not gonna bring that up. That's not a good fix for this. So that's basically it. There really aren't a lot of great options. Kind of deal with it, or sell it and deal with the tax impacts. Or if you have stuff that are at gains and losses, you can kind of tactically sell off some things and whilst trying to minimize the present day, capital gain or loss on it. A state is the beneficiary of a 401k who pays. A state is the beneficiary of a 401k who pays taxes. I'm not sure if that's a question or a statement or a response to someone else. Yeah, Shauna often sees comments in the group that people fear IRMAA and are trying to avoid it at all costs, but the cost of avoiding IRMAA might far outweigh embracing IRMAA. Exactly it. And a lot of this is educated guess about the future, right? What will the costs or savings be? Tell me with certainty what taxes are going to look like in 20 years. Then I'll give you a finite answer. But that's the difficulty in all this tax planning stuff. The tax tail commonly wags the dog. IRMAA, Social Security taxation, state income tax, long-term capital gain, blah, 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 blah. Yeah, right. Okay. Any other questions or comments? Dave Fultz. When will my article on Roth conversions be coming out? Rethinking 65? I don't know. Should be any day. I sent my draft to the editors a few days ago. They gave me back their comments today. I gave them back my comments to their comments today. I think we're all done. So I don't know what their pipeline is of other articles pending in the hopper, but I will be sure to post it in the group as soon as it's out. Because I have this conversation all the time with clients and people in the group. One of the most common questions and the most difficult to answer is, should I do Roth conversions and how much? And I hate, at the risk of sounding like a cop-out, I'm like, I don't want to show you. I can produce some report in my financial planning software. I can make the results look like whatever I want them to look like based on what assumptions I make about the future of taxes and financial markets and inflation and your own longevity. But it's going to be wrong. I'm just taking a stab in the dark here. So I view it, and this is what I outlined in the article, I view it as a qualitative discussion about the pros and cons, about the different variables that will impact your ultimate value realized by these conversions. And let's have a conversation. I feel like it's sort of my gut tells me when conversions make sense. Now, I know I can't say to clients, well, do it because my gut says so, right? I need to try to articulate as much as possible. But that's the conversation and thought process that I have. And I got that all dumped out on paper in this article that'll be coming out soon. So I will definitely share. Hopefully you all find it useful. Does our Roth account is included in the RMD or just tax deferred accounts? So it depends what you're talking about. Roth IRAs are not subject to RMDs if it's your own Roth IRA. If it's a Roth IRA you inherited from someone, it is subject to RMDs or getting cleared out within 10 years, but I assume that's not what you're asking. If it's your Roth 401k, that is subject to RMDs. You won't be taxed on the distributions, but if you will have to start taking money out in the year you turn 72 from your Roth IRA. And as we've been talking about so far, that RMD may get bumped up to 75 instead of 72, but that's not far from final at this point. So don't bank on it. Okay. Looks like that is it. I guess we'll wrap here, right? Exactly an hour, 59 minutes, because I was a minute late. But thank you all for the questions and engagement, and others chiming in here as always. Dave, Cody, Shauna, lots of contributions here today. Mark, always a crowd favorite. Thank you all. That's it. Next week's topic, I don't even know. What is next? What's next week? Oh, Cody's next week, right? It's the second Wednesday of the month. So whatever's Cody's talking about next week, I'm sure that'll be a good one. So stick around. I'll see you then. Otherwise, I will see you in the group throughout the week. Take care. Good night, all.